So good morning everybody. It's still morning, so great to be here it's always a pleasure to be at the Global Fintech Fest 2025 for this fireside chat on digital risk intelligence and credit enablement in India's growth story. Pleasure to introduce two very eminent professionals, Shashank Mehta from ICICI Bank and Vinayak Venkatraman from Tata AIG, both of who are very eminent professionals with significant experience in their own domains. And we are here today to talk on this topic, and I'm sure it will be quite insightful for all of you. Just to set context, and we've seen that over the past few years, India has very successfully built one of the most advanced digital infrastructure ecosystems in the world, either by way of Aadhaar, UPI, account aggregators, and OCE, and all of it is coming together really well. And these platforms have actually made it easier for millions of both individuals and small businesses to access formal finance. However, India is a massive country. I mean, the MSMEs are roughly about 60 to 70 million, depending on the source that you look at, and they are also considered to be the backbone of our economy. So, access to timely and affordable credit, to MSME especially, still remains a challenge. And this is where digital risk intelligence comes in. There are all kinds of data that we use to assess risk, right from trade data to GST records to payments and supply chain information, and a lot of unstructured data. And on top of it, we apply analytics and AI, and we can actually, using all of this, we can make lending more accurate, faster, and fairer. And it will also help both lenders and insurers take better decisions, and also give small businesses more confidence to grow. Right. So with this as context, I'll straight away jump onto the topic, because I don't I there's lots that we can discuss between us. I'd like to straight away jump onto you, Shashank,
Yeah.
given your experience, at least two decades plus experience in the banking world. We've seen that the Reserve Bank has they've been driving a lot of initiatives around automated risk screening, video KYC, and digital compliance. So, according to you, how is it reshaping the MSMEs, and how are MSMEs and exporters able to access credit today as a result of all of these changes that RBI has brought about?
So, at the outset, thanks, Mohan, for having me here. And of course, it's an exchange of views. And as we exchange, we gain more insights. Coming straight to your question, uh, the digital public infrastructure that we have in place today, developed over a decade, uh, despite that, we see a lot of growth on the retail or consumer lending. I think it's growing at 17 to 18% CAGR over the last 5 years. The share of retail lending also in the overall, non-food credit mix has grown to around 30%. But MSME lending still is at 18% share, despite all the importance to the sector. These measures like video eKYC or e-screening, definitely the first advantage that they give, or the first benefit that they give, is cutting time to market. So the entire LC issuance process, for instance, in most of the banks today is fully automated, integrated right from where the bill of lading is lodged, uh, to the entire issuance process, and even the ultimate reporting to the regulator. So in the good old days, it used to take about 7 to 10 days. Then it cut down to 4 days about a year back. But now you are doing LC issuances in a matter of days or within the day itself. So that's a very big benefit to both bank as well as the customer or the exporter. New to bank MSMEs or new to bank customers who have not yet opened an account with us, there also the e-screening, account aggregator, also a lot of these common operations. You have eKYC, so I don't need to take signature cards from everyone for that. So the account opening process, the actually transaction processing becomes much faster. Coming to credit assessment, a lot has been achieved, lot still to be achieved. When we use unstructured data, we still, most of us still rely on the audited financials, etc. The unstructured or informal data in the form of GST in and the other stuff, I think still has to evolve as the models evolve. So how we can incorporate them well into the models is what we have to see. But yes, a lot of traction in the market. In our credit assessments, we do look at GST and the other e-khatas, etc., to make an assessment for MSMEs.
So clearly, basis what you're saying, the ease, speed, and transparency has gone up in a big way.
Absolutely,
But
absolutely.
as a follow-up, do you think all of this will actually reduce the onboarding friction for MSMEs as we progress?
A lot of it already is. So, we've a lot of places where you have program-based sanctions. You develop a model, a criteria to, fit a certain MSME into it, and you give large-scale sanctions. It is being done based on scorecard-driven models, where we use a mix of structured and unstructured data. Going forward, when you have to extend this model to even smaller businesses, or maybe you want to give credit to the roadside vendor also, or the
Yeah.
artisan, or people like the last mile, that is where a lot of work needs to be done. Yes, the backbone in the form of a digital public infrastructure that you said, to set context, we have a very robust, and as these evolve and these integrate with various other digital databases of the country, it will be phenomenal growth that we'll see in
That's
this
good.
segment.
That's good, Shashank. No, I just want to bring another important aspect of the discussion around adoption and awareness related issues or challenges that we encounter. And both of you interact very closely with both corporates and MSMEs. And therefore, this question. So, what according to you is actually holding adoption? Is it adoption of the digital tools for risk assessment. Is it to do with overall lack of awareness, or is it an issue with data quality, or is it anything to do with the overall trust in the process? Either of you. I'd like to hear both of your perspectives on this one.
I'll start off. Yeah.
Yeah.
So I'll just start off with this. So lack of awareness, as you rightly said, the lack of awareness, as you rightly said, I think was one of the issues. But from my perspective, or if I have to talk about credit insurance, that is definitely improving. Because at least today we are in a situation where everybody is at least talking about using digitized platforms, AI-backed tools for the credit assessment point of view. And I'll be glad to share that we are actually in the process of experimenting or conducting some pilots, by how we can actually use these advanced models to make our lives simpler. But I think the real challenge, there will be two main points that is probably holding back the adoption at this stage. One of them I would say is the availability of data. Because the availability of data is so scattered that it's sometimes it's impossible for us to get everything under one roof. I think first that has to be increased. And I'm
Solid.
talking from the point where, so today we have a huge database of almost 15,000 buyers that we look at, and a lot of them would actually be proprietorship and partnership firms. So that is where the real struggle is, when it comes to conducting credit assessments. Now, for us to be digitally well equipped and get solutions which will probably require very less manual intervention, there has to be a model which will factor these things as well. So, which I think we are progressing, but it will take some time to get there. So that is one of the challenges. The second point here is, I think this will come to shape better if talking about big volumes. So maybe in banking, that the time is right and react. But when it comes to credit insurance, it's still a market which is very well, it's very underpenetrated in India,
Got
and there is huge scope to probably expand. So as I said, so we are one of the largest insurers in this space, and if we are talking about 15,000 buyers on an annual basis, so what if that actually moves to 1 lakh or
Multiplies.
2 lakh? So that, and the scope is there. So that's where we can really leverage on this. Is what I think.
Perfect, Vinayak. Quick word from you,
So,
Shashank.
yeah, Mohan. So, I think on the awareness part, I think the awareness in the banking industry is there, because if you see across the banking segments, private sector, public sector banks, almost everybody today has an AI or a digital strategy. uh, Over the last 10 years, a lot of processes have evolved. Earlier, AI or automation was for, neutral processes, back-end number crunching, not, impacting the direct business. But slowly models are evolving, and which is why you see this huge growth in numbers. So if that is one indicator, I'll say the RBI Financial Inclusion Index, it was at around 43, 44 levels. 5 years
Right.
ago, it is touching near 70, 67 is what the latest. And it shows that the lending, especially on the personal digital lending, it's not just the amount of loans increasing, or the volume of loans increasing. It is actually the size of number of borrowers expanding. So you can't reach that scale without some digital strategy. But where the constraints are, I think, is, as you pointed out, one is, of course, unstructured data. How do we harness it? Within a bank itself, there are huge chunks of data processed by various parts of the bank, and neither division knows. Processing trade related data itself generates huge information and digital footprint. If we can know, uh, use it for either credit assessment, use it for business development, either which ways. So that part is there. And then the fear around you are using AI, this thing, you have fraud and other malware related issues. The banking sector, I think, is working towards building a governance model around it, where they can handle these things better. that
Got
that's
it.
that is what I
So
think.
essentially, you're saying, in both of you, in many ways, you're saying that the adoption is picking up in a big way, but trust and familiarity around the
Absolutely.
utility is evolving more or less.
And insurance will then, going ahead, play a very key role.
Absolutely,
Yeah.
absolutely. Cool. I'll just quickly switch to another important topic around the overall fintech participation and collaboration. There is a lot of buzz around how fintechs are coming into play into this ecosystem, and they are becoming extremely important players in the MSME credit ecosystem, so to speak. So, what kind of a role you see them playing? Are they are they essentially collaborators, competitors, or they are more or less enablers in the entire game? It'll again be good to hear both of your perspectives on this.
So I'll come in on that. I think if you look at the broader vision of the country of becoming Viksit Bharat by 2047, and therefore ensure that everybody has a bank account, everybody has access to credit and financial services and investments. If everybody looks that way, then we are all collaborators. Fintechs, with their technological prowess and processing capabilities, can help banks reach very far. Last mile credit, for example. Uh, but at the same time, we have to see I think the awareness around how do we manage the collaboration with fintechs. You allow them plug into their systems, you are opening access of a bank system to a fintech, you are making yourself vulnerable from a security point of view. So once we have all those bearings in place, it is collaboration all the way.
How about you, Vinayak?
Sure, yeah. So I think I agree to what Shashank actually mentioned. Now, I think the biggest, it's definitely an enabler, and the biggest contribution that fintech could make would be the technology that they are able to bring in. I think that's going to be the biggest contribution, because I think fundamentally everyone knows how great the system is. It's the speed and the decision making that we quicken because of the adoption of technology. That's going to be the biggest contributor. In fact, so when you talk about credit insurance in India, primarily there are two big products. One is trade credit insurance. The other would be surety insurance, which is really gaining a lot of traction in the last 2 years, and is basically uh, is a substitute for bank guarantee. Now, we are already seeing firms, fintech firms, who are looking to, at least on the surety insurance side, where the underwriting can be standardized to an extent. where they're actually we're looking at firms who are building fintech companies to cater to the requirement of SureTech, where everything will be done by the platform. Ultimately, the job of the insurance company will be only to decide on the pricing and probably issue a bond. So that way, there is good progress there. And as I said, technology remains the biggest influence that they can have on the entire ecosystem.
Perfect. So in summary, again, what both of you all are tending to say is that this is more collaborative in nature
Absolutely.
than being competitive as it was, perceived earlier.
Correct. And not just fintech, you have regtech now, you have the
Correct.
entire ecosystem of
Absolutely. Absolutely.
the information providers, Sibyl and the other stuff, data insight providers. Some Milke, I think we will be able
Got
to.
it. No, interesting. Uh, Next, I'd like to very quickly leverage on your experience, Shashank, and of course Vinayak too. But on this whole thing about risk data and EWS, right? So, and you also touched upon it earlier, where you mentioned about a plethora of structured and unstructured data, available in today's times. Be it by way of transaction flows or supply chain data, payment trends, whatever that one can get a handle on to. So, how do you see predictive analytics and AI, especially in the banking industry? How do you think that will play out for banks in detecting stress early and you know enabling the banks to manage the risks better as a result?
So a lot of action is already happening because RBI has been asking banks to evolve a strong early warning signal system. So most of the banks that we know, they have somewhere a system in place, and slowly it is getting, from just a dormant reading of stock statements and receive and bringing out insights, it's actually becoming very analytical in nature.
No, if you can also just touch upon maybe a case of, I mean, where this has come to use and you all have been able to prevent a potential NPA, right?
So, see, a lot of insights comes from analyzing the account transaction data of a customer, especially if that customer, you have a big share of his flows and you are a prominent banker to him. In that case, what happens is you can then look at trends in the account, and if it's the main account, sometimes then the trend becomes very boring. Every month you see the same counterparties getting payment, the same trend of bills being played or the collections coming in, and that's when a flag comes in when you see an unusual transaction happening. Or sometimes in large conglomerates, related party transactions which do not meet the eye sometimes, or at least they raise a question, and people who are monitoring can raise a red flag and ask the teams to check with the client. So there are instances where, like these unusual transactions, moving of money within the group, which may not be for very I won't say clean, but for purposes that do not meet the eye,
Right.
that is there. Even from a sanctions or from a OFAC perspective, are they dealing with the correct counterparties? So a very simple thing like an annual account statement gives those insights. Then when you compare past stock and inventory and receivable statements, sometimes insights come from there also. Uh, you check price trends, what prices have the raw materials been purchased from, what are the market trends. So when these are integrated in the EWS system, they throw triggers basis which at least you can reach out to the customer and ask, and then figure out if actually it is something in the usual course of business or you need to stop
So
business.
essentially, it's being effectively used in the
It is
banking
being
world.
effectively used, and increasingly now, on the other part of it, Mohan, this is from the structured
Yeah.
things available. Now you have trade data, you have other payments related data which are floating across the bank. Sometimes even a simple thing like when you are reporting overseas investment in subsidiaries to RBI, each statement is a huge data mine of information. You want to know ultimate beneficial ownership, for example.
Right.
So, or the IDPMS, EDPMS reporting. So, somewhere if banks can put their minds together and synthesize this data, there is huge insights available to not only for EWS, also for business analysis.
Got it. quick word from you on this.
Yes, I think
Vinayak.
EWS is always going to be an essential tool wherever there is credit assessment involved. The only thing is, so from a trade credit perspective, it's just going to be a 12-month horizon typically that we take. So any kind of predictive analysis that has to come in. So the good thing with us is in India, the limits that we give to our policyholders are cancelable. So even at any point of time, if there is any kind of a risk, we have the flexibility to cancel the limits. So from that point of view, definitely predictive analysis is going to be useful. However, the only constraint here is even with the models that are there currently, we always use historical data. So if using AI or maybe machine learning or other
Predictive models.
models, if we are actually able to factor in the behavioral patterns, in any kind of predictions that we make, I think that's going to be the game changer in the future.
Got it. No, interesting. Now, next is, in fact, a question around credit insurance because on one side it is underpenetrated, but on the other side, people are beginning to see the importance of credit insurance in the overall scheme of things, right? So whether so how can essentially credit insurance and especially risk sharing mechanisms encourage lenders and corporates to transact, business more confidently with MSMEs? I mean, any thoughts that you have on this in terms of how this can go up in a big way?
Yes, so I think there is progress on this front. So just earlier we were discussing on the Creds platform that is coming, which essentially allows us to uh, insure a bank for all the factoring or the invoice discounting programs they do for the MSME sellers. So and that's mainly for the MSME sellers. So indirectly we are also supporting the MSME sector and also instilling the confidence amongst banks to go for their focus on their core activity, which is lending, and we take care of the risk at the back end because the transactions there tend to be non-recourse to the seller. So that way, we are offering that comfort and protection. And from a larger context, credit insurance or credit insurance in India is done in a very limited manner right now, and that's because the regulatory guidelines are as such. I think as we move along and with the vision of Viksit Bharat 2047, I think if you look at the larger picture, I think there is a lot of scope, from an overall regulatory and the entire financial ecosystem perspective to make path-breaking changes. Because credit insurance in Europe or US is way beyond credit cards, right? I mean, we can actually go to the extent of covering most of the banks lending portfolio. I think that's the extent of penetration that needs to come. And also, from the regulators' side, there has to be some incentives. So I think the banks here today are trying for the capital relief. They're speaking to the regulators for that. But these things are already, done when you talk about the some of the developed markets. So I think once these changes come in, I think credit insurance in India will really take off.
Interesting. No, I'd just like to very quickly jump on to another important point around pricing, right? Because we talked about data and insights that we drive through various kinds of data that we are able to access today, right? So we are no longer at a stage where we're looking at dated data for our assessment. So when the data is becoming more dynamic and real time, right? So do you envisage a future where uh, both lending and the insurance pricing are more dynamic and actually personalized to their actual risk profiles, be it for individuals or for MSMEs? Again, it will be good to hear both of your views on this.
So Mohan, as the lending models have evolved, it's all about the backbone is credit history. The more credit history we have and the more pattern of good credit conduct we have, of course the lender or the borrower should get the benefit of that. We are seeing this in some manner in the personal lending space. And as you open your mobile banking app, sometimes you get your pre-approved loan offers or a auto loan or a personal loan, and you get a certain pricing there, which is essentially based on your conduct and your past data from your CIBIL scores, your payment transaction data, etc. are processed, and a borrower profile is found out. Based on that, some dynamic pricing of course is happening. On the SME front, yes, we need to do a lot of work, and as as I said earlier, we have a very strong digital public infrastructure in place. Uh, that is also evolving. So at the MSME level, when we go granular, so you have you have the ULI. When the ULI integrates with, say, NABARD's eKYC database, or it goes further down to scheduled cooperative banks, district cooperative bank level digital data, or the data that is being digitized at government level, you get more granular on transactions, etc., and we can also offer similar pricing benefits to MSME customers also.
How about in the insurance space, Vinayak?
Right. So I think when it comes to data, I think the more the merrier. I mean, the more the data we have, the better we're able to, assess
Price it.
and come closer to the, or maybe more accurate pricing. That is what we're looking at. But having said that, even today, despite the lack of tools, etc., I think the pricing tends to be little dynamic. Because I mean, what I mean by that is, so today, if I look at two different corporates, very similar balance sheet, very similar operating scale. Now, if one is probably in an FMCG sector, the other is probably in a commodity sector, there will be a differentiation. So, because your payment cycle in a FMCG entity will be far shorter than what you would have, and even from a risk perspective, commodities will be riskier. So that way there is customization, there is dynamism, right? So, but having said that, I think what tools or what digitization will help is at least kind of to get a larger data at our disposal, a larger universe in which the peer comparison can get more accurate. So yes, there is definitely room for more dynamism.
So we can definitely look for a time where
Absolutely.
data-driven pricing will become the norm, right?
Absolutely.
Going forward. Perfect. So I mean, very quickly again, we touched upon this topic, Shashank. Around we talked about digital infrastructure and how it'll the risk infrastructure, especially in the digital format, can enable or empower first-time borrowers or even small borrowers to access formal credits. You touched upon it, but if you could just throw more light on how this can be made possible, especially for the new borrowers, that will be helpful for the audience.
Sure, Mohan. So, see, the first, if you look at the way AI and these tools have evolved in India, the first banking revolution was when we saw ATMs coming up. I think the next phase was the Jam trilogy. Uh, Janadhan, Aadhaar, and your mobile, they work magic. Now you have Jam plus the unified lending interface.
ULI.
That is the next driver. We have credit scores from CIBIL for most of us people, customers of banks in the urban, sphere. And the awareness about our CIBIL scores or bureau scores is also fairly high now. We all once in a while look into those scores and check where we stand. But this kind of scoring may get restricted when you are wanting to assess the capacity of someone in a rural setting.
Got it.
So the initiative of setting up a Grameen score, that will be another very key positive. Already work is on
That is good.
on that. Then again, as I said, when we are integrating a lot of digital records with within the ULI, that creates more patterns and opens the gates for smaller MSMEs, rural artisans, roadside vendors to avail credit at the hit of a button. And of course, you have the backbone of JAM, anyways available. Disbursements through UPI, a lot of then payment history comes through. So increasingly, Janadhan account is already created. I think we have about 16 crore odd Janadhan accounts, and of that, close to 70% are from rural areas. So that's a wonderful achievement over the years. So with all these initiatives, we will see MSME and or they call it the invisible borrowers. The term is invisible borrowers coming to the fore and getting easy access
So
to
this is
credit.
clearly where the India's growth story sort of
Absolutely,
expands, right?
absolutely, Mohan. Yes.
Empowering the next million set of borrowers.
Absolutely. And their insight providers, intelligence providers will also have a very key role to play.
Got it. Got
Yeah.
it. Cool. Very quickly, this is my last question to both of you, and but it's an important one, especially since we touched upon the Vision 2047 for India, right? So if India has to truly be a developed economy by 2047, and we talked about the collaboration between the entire ecosystem, be it banks, insurers, fintechs, and the entire financial world. So, what role you think this collaboration will play in actually building a very resilient trade finance ecosystem? It'll be good to give your concluding remarks in terms of how this is set to emerge as we progress.
Vinayak?
So I think to keep it short, I think credit insurers will have a very active role to play. In fact, every participant in the entire ecosystem will be a facilitator, whether it's a fintech, whether it's a financer, whether it's an insurer. Because for us to achieve what we are aiming for, I mean, in 2047, there has to be a surge, in the MSME space or the mid-corporate space. So that's where primarily the challenge comes when it comes to funding or financing at this point of time. We are seeing that in surety slowly happening. So a lot of people come to us because we do not charge collateral. Right? Unlike typically a bank where collateral-based lending is more prominent,
Yeah.
right? And if you are looking at these new age models to evolve, platforms evolving, ultimately we are going to be surrounded or thrown, so much data is going to be thrown on us that I think 20 years down the line, non-collateralized lending could be the norm, and that is where insurers would be really important.
Absolutely.
Okay. So I think, Mohan, achieving the 2047 vision, the bearings are very strongly in place. As I said earlier also, the JAM plus ULI plus the other levers put us in a very strong position to capitalize. And for Viksit Bharat, if we need everyone to have a bank account, everyone to have access to reasonable credit services and investment options, these three things, the bearings are in place. I think what we need to be mindful about is when we create our models based on unstructured data. See, unstructured data will also, as Vinayak said, help us move from asset-based lending to cash flow-based lending models. But are we assessing the right kind of data? Is there noise in the or bias in the data that needs to be managed well? What is the source of the data that we are using? A very good directional tool is the seven sutras that have come from RBI very recently. And that overall governance framework that has been prescribed, if all banks and other, all regulated entities and their collaborators can work towards that, 2047, the bearings are very strongly in place.
Excellent. So on that optimistic note, thank you very much, both Shashank and Vinayak, for
Thank you.
a very insightful and engaging discussion. Sure. I mean, just from my perspective, I just want to conclude from my perspective. Again, it is becoming extremely clear that the digital risk intelligence, the topic for our, the discussion that we just had, is not just about data and technology. It's about enabling trust, overall inclusion between all of these ecosystems and growth, right? And when, again, like we talked about, when banks, insurers, and fintechs come together, we can actually make access to credit a lot fairer, faster, and in fact more accessible to
Absolutely.
the 60, 70 million plus MSMEs in India today. Perfect. On that note, thank you very much, gentlemen, and wish you all a very good day.
Thank
Thank you.
you.
Thank you for
Thank you
having
so much.
us.